In this video, we're going to be performing a deep dive on S&P Global's dividend safety. To begin, let's talk about S&P Global's business model. S&P Global is a worldwide provider of financial services and business information with a market capitalization of $43 billion. Last year, it generated 54% of its operating income from its ratings segment, 30% from market and commodities intelligence, and the remaining 16% from S&P Dow Jones Indices. S&P Global is a well-known dividend stock because of its compelling track record of dividend growth. With 45 years of consecutive dividend increases, S&P Global is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on S&P Global's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss S&P Global's dividend safety in the context of the company's current earnings. When S&P Global announced its third quarter financial results on October 25th, the company reported that it generated adjusted earnings per share of $2.11 in the 3-month reporting period. For context, the company currently pays a 50-cent quarterly dividend, which implies a payout ratio of 24% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. S&P Global expects to generate adjusted earnings per share of approximately $8.55 in fiscal 2018. The company should pay about $2 of common share dividends during the same time period, for a dividend payout ratio of 23%. Using earnings, S&P Global's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare S&P Global's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, S&P Global generated $1.4 billion of cash flow from operating activities and spent just $88 million on capital expenditures for free cash flow of approximately $1.3 billion. S&P Global distributed $379 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 29%. Using free cash flow, our conclusion is the same as when we use earnings to measure S&P Global's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze S&P Global's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Unfortunately, this is not feasible with S&P Global because until 2013, it was a part of McGraw-Hill Companies. S&P Global was spun out in a transaction that occurred in 2013. Instead, we believe it makes sense to consider the financial crisis performance of S&P Global's main competitor, Moody's Corporation. Moody's performance during this time period is shown here. Moody's earnings declined by 32% in the financial crisis, which is about average among large-cap stocks. S&P Global's performance was likely similar. With that in mind, we do not have any concerns about the company's ability to continue paying its dividend during future economic downturns, although it is far from the most recession-resistant stock in our investment universe. The last angle that we will use to assess S&P Global's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, S&P Global generated $98 million of interest expense and had $3.7 billion of debt outstanding for a weighted average interest rate of 3.5%. The following image shows how changes to S&P Global's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, S&P Global's weighted average interest rate would need to rise to well above the 30% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on S&P Global's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.